Number 6, a company has the following projected liability cash flows. There are 3 assets available for investment: a 2-year bond with annual coupons of 7%, a 4-year bond with annual coupons of 4%, and a 5-year bond with annual coupons of 3%. Each bond has a par value of $100. The annual effective yield rate on all 3 bonds is 5%. The company has decided to pursue a dedication strategy. Determine the amount of each bond to be purchased and calculate the cost of establishing the asset portfolio. So this is a fairly lengthy question, but a very easy to solve mathematically. So we have a final cash flow of $824, and we need to divide that by the final payout of the 5-year bond, because this cash flow occurs in 5 years. Now the final payout of the 5-year bond will be its $100 par value plus its 3% coupon. Therefore, we need exactly 8 of these bonds. Now for the year 4 cash flow, we have $3,144 that needs to be paid out. And the final cash flow of the 4-year bond will be exactly $104. But we also need to take into account the coupons from the 5-year bond, because the coupons are 3 and we have 8 5-year bonds. We need to subtract $24 from the 4-year payout. This is all going to be divided by the payout of $104 from the 4-year bond, meaning that we need 30 4-year bonds total. Now for the year 3 cash flow, we have a total cash flow of $144. And since we have no year 3 bonds, we can hope that the coupons will cancel this cash flow out. And if it does, then everything is well so far. So from the 5-year bonds, we can subtract 24. From the 4-year bonds, coupons of $4 times 30 of them, we can subtract another 120, and this does indeed cancel out the cash flow. Now for year number 2, we have a total payout of $679. Now we need to subtract the bonds, or the coupons, pardon me, and divide by the final cash flow of the year 2 bond. And the year 2 bond has coupons of 7%, meaning that its final cash flow will be $107. And we will need exactly 5 of these bonds. Lastly, for the year 1 cash flow, we have a cash flow of $179, subtracting the coupons, minus 35, for a total of 0. Now, the question also asks us to establish the price of the asset portfolio. Therefore, we need to figure out the prices of every single one of the bonds that we have. So here we have a 2-year bond, and the price of the 2-year bond are its coupons brought back to present value, and there's only 2 coupons, plus its final par value of $100 brought back 2 years at 5% interest, for a total price of $103.72. For the 4-year bond, we do a very similar thing for a total price of $96.45. For the 5-year bond, once again, same process, $91.34. And lastly, the total cost for the asset portfolio is simply the price of every single one of these bonds times the amount of bonds that we've purchased. So we purchased 8 5-year bond plus 30 4-year bonds plus 5 2-year bonds. And just plugging in the prices of these bonds will yield a total of $4,142.94.